It is 10 a.m. on the 27th of April. My name is Boaz Shoshan, and I'm back here hosting our market broadcast here at Southbank Investment Research. I hope this broadcast finds you in good health. It's looking quite overcast here in London today, actually, despite all the incredibly good weather we've had over the last few days. But today it is looking a bit cloudy, and it's going to be a very interesting week to come. So, as I'm sure you noticed, last week we saw oil prices in the US manage to go into negative territory, or at least it did in the futures market at the very least. And this week we have not only, we've got all the repercussions of that going on, but it's actually a massive earnings week. It's earnings season in earnest this week, where we have some of the biggest companies in the world are going to actually announce what their earnings have been over the last quarter.
Earnings? What are those, Grandad?
Indeed. What do you remember earnings? Where were you when you last saw
I
earnings?
remember when companies were profitable.
Tim, thank you very much for joining me on this call. I would love to know what your view is on what we're going to see later this week, because it's such a big mix of companies. You've got the Amazons and the Alphabets, all the tech ones, but then you've got BP and Exxon, and then Visa. Everyone's being encouraged not to use cash now. You'd imagine Visa were making some money. What do you think? What do you think we're going to see?
It's interesting you just on that briefly on the topic of cash, because I
Mm.
just credit where credit's due. So I just tweeted Tesco, because their England's Lane branch in North London has put up signs dissuading customers from using cash and encouraging them to use cards. And I just asked them why, and they said no, they're perfectly happy to take cash. So I think I get the sense that there is, let's say, disunion in the ranks, and that individual stores are kind of going their own way and then being battered back into behaving properly by head office. But it's just interesting to see that there is some, let's say, disturbance in the force when it comes to fiscal payments in the shops at the moment. But I think Tesco, to be fair, otherwise has had a very good crisis in terms of stepping up to the plate and arranging normal life to continue as best it can in a lockdown. So that they get kind of at least one thumb up from me on that front. In terms of the earnings situation, I've suggested for a while now that, I mean, somewhat simplistically perhaps, but the best way to look at the stock market is to basically triage either the market or your individual portfolio in terms of three categories of stocks. So there are let's say the green, there's the green stocks, which won't be many, but they're the ones that will actually benefit from this mess, and they would be the likes of Amazon, Netflix, and you mentioned Visa, companies that are actually likely to end up even stronger as a result of the trends that will be magnified by the COVID pandemic. Then you've got probably the largest sector, which is called amber, which are companies that are going to be impaired but will probably make it through, albeit with diminished earnings, to use that word again. And then there's the red stocks, and the red stocks may not make it, and they may not make it irrespective of whether they get taxpayer support or not, because at the moment obviously everybody is queuing to get to feed at the trough, and not every company will get access to that. So that would be the way I'd split the market up, whether it's UK or internationally: green, amber, and red. And the green stocks probably are too expensive. They're certainly too expensive for me anyway, because the metric I would use to be something relating to cash flow and enterprise value. There's a metric, sort of enterprise value to cash from operations, for example. And on that basis, the likes of Amazon and Netflix probably will never be cheap enough for me to be interested in them, because I prefer to be defensively positioned, and I don't like paying up for anything. Value is as value does, and all that. But notwithstanding that, there are clearly going to be winners and losers. So sectors like, for example, healthcare, disinfectant, bleach, companies that are involved in pharmaceuticals, probably many of those are quite well positioned. And some of them may even get lucky with a vaccine, who knows. But then you've got, so the amber sector is really the one that's probably most relevant to people, because there's going to be plenty of companies. You mentioned the oil collapse last week. We're in such an extraordinary environment now that, I mean, first I think you can expect bankruptcies in the alternative oil space. There's a shale and fracking space in the States.
Yeah.
There's been huge downgrades of creditworthiness by the likes of Moody's over the last couple of months, and that process is probably only going to accelerate. So basically, choose your stocks with extreme care. But the best advice I could give would be to sort of echo the words of Warren Buffett, namely, don't consider owning a stock for 5 minutes if you're not happy owning that same stock for 5 years, or if the market were potentially even to close. And I think that one of the strongest metaphors that Buffett's ever used is this example of the punch card. That imagine someone at the start of your investing career gives you a punch card with sort of 20 chads or dimples or whatever you want to call them on it, and every time you make an investment, you use up one of those punches. So basically, you're only allowed to buy 20 things in your life. If you take that kind of approach in this market, I think you'll be well served by that. I find the current rally, for example, utterly delusional. Signs of basically a dead cat bounce or relief rally, but I for the life of me, I can't see it's justified. So I would expect, as the news flow gets worse over the weeks and months to come, that the stock markets generally will start to react to economic gravity.
Yeah, I like I think it's a good idea to sort of put companies into that sort of categorization. On that note, we say you got the companies that are actually doing well out of the current lockdown. So Twitter's obviously going to been getting an awful lot more eyeballs and a lot more usership, I would say, over the last during these times, and the same with the likes of Amazon as well. Do you think that impact is transitory or permanent?
What, in terms of behaviors for the likes of customers using businesses like Amazon?
Yeah.
I mean, not to be sort of cynical or grisly about this, but I mean, Amazon couldn't have wished for a better, if you like, a kind of stress test of its business model. The one closer to home for me is Deliveroo, or Deliver Booze, as I've sort of taken to calling it. So you can see where my interests lie.
The utility, yeah.
As I say, I mean, I tweeted one of these the other day that what I sort of rather ironically referred to as lunch in inverted commas. I put in an order for a shop near me in Hampstead, and I think from order through to receipt of quote lunch unquote at my door, I think it took 9 minutes. Now that is just stunning, and that's in the middle of a global pandemic. So it's a sign of just how well some companies are stepping up to the plate, almost literally in this case. And so, I take my hat. This is how capitalism is supposed to work. Of course, there'll be winners and losers, but whether it's by luck or by judgment or combination of the two, there are some companies out there that are very well positioned. And to go back to your initial question, I suspect we don't know. It's far too early to say, but I suspect that a lot of people's behaviours will be changed permanently as a result of what we've all experienced over the last few months. And I think people will. Well, on the negative side, there's a great line, there's a great phrase that J.K. Galbraith uses in his book, his account of the Great Crash in 1929, where he talks about the rise of the bezel. And the bezel is basically the fraud, the Ponzi scheme that arises during the good times. And when the bad times arise, it takes a little bit of time for everyone to wake up to what's gone on. And after the bezel is discovered, then everyone suddenly starts looking at each other with a more suspicious eye. And that segment of the book is just terrific reading. I mean, I would recommend Galbraith's The Great Crash 1929 to anybody. A, because it clearly has relevance potentially to what we're going to be experiencing in markets in the future, if we haven't already experienced it. But more to the point, it is some of the most brilliant prose I've ever read. And this is someone who read English.
Yeah, it's I've not read it cover to cover, but I have read.
He's absolutely a master of an absolute wordsmith.
Yes, with the on that note, with companies that prosper and do well during this time, I think it'll be very interesting to see whether or not those businesses that are giving results, are announcing greater earnings, that they are growing their business, etc. Whether or not that will be immediately reflected in their shares, or whether or not these companies, due to the rise of passive investing and passive investment flows, whether or not they will be punished along with everybody else just from money leaving the market, in large swathes. Do you have any ideas on that? Because
Well,
we've spoken a lot on passive investing
yeah,
in the
I
past,
mean,
and the
we've
impact on that.
we've certainly seen some very counterintuitive moves in markets, and it may be that basically, I mean, bear in mind the market has had to adapt to effectively experiencing more or less the equivalent of World War II, possibly World War III, if you want to be really dark about it. But a world war, a depression, a lockdown, a sort of hard economic shutdown, deflation, and then huge stimulus, all in the course of a couple of months. So it is not surprising, perhaps, that the ramifications have, the dust is yet to settle. But there's certainly been some counterintuitive moves. The ones that I'm conscious of are, we've been buying, in my business, we've been buying shares of sensibly priced gold miners with little or no debt, because we think we can see inflation, signs of incipient inflation further down the line. And obviously we want some extra portfolio insurance in the form of gold and gold miners. But a lot of these companies have been taken out in a shot, even though they're actually reporting close to or at record revenues, record profits. So some of these moves are counterintuitive. However, you can make a case for why they're happening. And one, for example, here's a hypothetical. One reason why, say, a small mid-cap gold miner might get taken to the cleaners, even though it's doing very, very well, is simply because, let's say, an ETF might have liquidated its entire portfolio. So in that case, the market can be completely indiscriminate and just says, look, we want to sell everything. And, particularly in a small cap environment, if there's lots of selling and no bids, then the price goes through the floor.
Yeah, there's always that liquidity issue. And when you have, when people look to, for example, GDX, the gold mining ETF, or GDXJ, for the junior miners, when those are, when people instinctively think of the ETF rather than the specific companies, it seems inevitable that there are going to be those mismatches where the baby's thrown out with the bathwater, as it were.
I mean, you saw the same thing in gold itself, and that's something that we saw back in 2008 when, and this is a line I continually use. So in my encyclopedia of hoary old quotes, and this is the one that probably gets more of an airing than any other, which is, and this is something that I was told back in, around the time of the Lehman crisis, which is, if you're a distressed seller of an illiquid asset in a panicky environment, it is worse than being trapped in a crowded cinema that's on fire. It's like being trapped in a crowded cinema that's on fire, and the only possible way you can get out is by persuading someone outside to swap places with you. In other words, it's virtually impossible.
Right. Yeah, it's a great metaphor for it. Everyone, because everyone seems to forget that for every buyer,
for every seller, there's a buyer, and vice versa. Exactly.
So whenever somebody, when the prices of things collapse, people tend to forget that there was somebody who bought it, and that's why that there was a lower price. There was somebody who decided, for example, last week that actually they would, buy a futures contract for negative $40. It would be incredible to know who that person was, and why they decided, actually, I will take $40 in order for delivery of how much West Texas Intermediate oil. But everyone always thinks of the people trying to sell it, rather with the people trying to buy it.
Well, there's a line. I mentioned Galbraith, and I think I'm channeling Galbraith now. So I've just put this week's price report to bed, and there's a piece here that I'm sure I got from the Great Crash, and I'll read you very briefly. It's only about 3 lines. So Tuesday, October 29th, 1929 would become what J.K. Galbraith called the most devastating day in the history of the New York stock market, and perhaps the most devastating day in the history of markets. As soon as the market opened, it was overwhelmed by a tsunami of selling that never abated. The stock of White Sewing Machine Company, for example, which had reached a high of $48 during previous months, had closed the day before at $11. During that Tuesday, an enterprising trader put in a bid for stock at $1 a share. Given the absence of any competing bids, the order was filled. Damn. So, there are incredible stories from then, and I'm sure the market has experienced and will experience similar stories this time around in the fullness of time.
On the, you've spoken of the interest in miners, and miners are part of the natural resource sector, and they of course have to have to follow the same playbook as all natural resource players. With that in mind, Tim, what is your take on what has gone on in oil over the last week? What do you make of it? I mean, it seems almost it seems almost logical that we've had negative all this negativity.
This is certainly surreal, isn't it? So I mean, in some respects, this is technical. So it's a technical thing about rolling futures contracts and stuff, which is very, 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 very arcane. But in another sense, I think it does reflect the fact that, basically one thing this pandemic is showing is that there is just zero international cooperation going on. And I mean, I've written in the past, and only sort of semi-ironically referred to this as sort of, basically the start of World War III, to the extent that whatever the source of the coronavirus, whether it was, it happened organically or whether it was, engineered in some kind of lab, I mean, it kind of doesn't really make any difference now, does it? Because the damage is done. But whatever the source, there's unequivocal evidence that China really screwed things up, whether deliberately or accidentally. For example, by prohibiting domestic travel from Wuhan, but allowing international travel, from Wuhan, which clearly just accelerated the spread outside China. So, I mean, there's no way that China can come out of this looking like anything other than a bad actor. But in terms of international cooperation, clearly also what's happened is that you've had, a lot of interested parties, including the Saudis, Russia, and the US, all basically sort of, basically trying to protect their own turf and screw over the opposition. So I think that's also a facet of what's happened in oil, which is, again, whether deliberately or inadvertently, because, OPEC has kind of lost control of the market. You've had basically, well, I mean, first, some of this is logical. It's completely logical that if you sort of switch at least half the world economy off, the oil price is going to go down. So I don't think anyone would argue with that. But then you've had all these kind of like, oh, we're going to pump more than you guys, and then you drive the price through the floor. And it's like the white sewing machine company example. In the absence of any bids, the market's just going to keep going. So, hoary old quote time. It's one of my favorites from the film Speed. When at the start of the film, if people haven't seen it, there's a sequence where there's some people on an elevator, and then there's a bomb on the elevator in the lift, and the lift starts hurtling to the ground, and then it stops and blah 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 blah. But what one of the characters says, what's going to stop this lift from falling? And somebody else says, the basement. and that's where we are in every market now, potentially. What's going to stop this market from falling? The basement.
Yeah, it's the basement bids that are going to be what finally catches it. It will be very interesting to see how these, as I say, that this earnings week is a real gargantuan.
Yeah, I think it's too early to say, because I mean, what are we going to be reporting? The first quarter, presumably. Well, half of the first quarter, this virus was only, was not even on people's radar. So the figures aren't going to be that meaningful, to be honest.
Well, they should be quite significant relative to the fourth quarter of last year.
Sure. But I'm just saying, is we haven't had the full impact. I mean, we still don't know when this lockdown's going to end.
Yep.
Anyway,
in terms of, you said you were looking at there were incipient indicators that more inflation is on the way. Tim, this does sound like the holy grail of macro analysis in general.
Yeah.
What if you wouldn't mind, if you could share this knowledge with us. What indicators are you looking at that makes you think that there will be more inflation on the way?
Well, I mean, you only have to look, for example, at the extent of the combined monetary and fiscal stimulus, which is tumbling out of every major government and central bank. So, sort of base money, if you like, is being sort of showered with abandon just about everywhere. So, let's say sort of ground zero, we've pretty much already achieved the introduction of MMT, modern monetary theory, namely everyone gets handouts. So you've had that in the UK with the paying furloughed staff scheme. You've had it in the States, where the States is going to send a check to everybody and their kids in the entire country. And what I guess once people have had a taste of free money, they probably decide they quite like it, so they probably won't give it up anytime soon. The presidential election in the US is going to be completely fascinating to watch this year, and I don't really follow American politics that closely, but it is going to be fascinating. So I don't have a strong view as to whether Trump's figures are going to be dented horribly or actually improved by the supposed handling of this. But there's just so much. So in terms of indicators, you look at what the money's being poured into the bath, And then in terms of the real economy, the underlying economy, it's too early to say because, of course, it's very difficult to spend money at the moment. So one of the counterintuitive things I'd say is the fact that, the likes of Tesla has been an extraordinarily strong performer at a time when people can't even leave their own homes. And even if they could leave their own homes, the allure of an electric car somehow has some of the gloss taken off when you consider what's happened to the oil price. So a lot of these things just don't make any sense. And it's going to, I say, it's way too early to start reading the runes. But in terms of indicators, firstly, gold itself, and then choose your currency in which you want to price it. But the fact that gold is looking pretty firm now, even in the dollar, and the dollar itself is looking firm relative to other currencies. These are, I would say, obviously bullish for bullion, bullish for gold, but they're also disturbing, let's say, for the potential impact of inflation. And if you want to see a sort of industrial indicator, then you look at copper. You look at the copper price recovering, which I don't think is anywhere close to doing at the moment.
Yeah, Dr. Copper does not seem to be in good health.
And of course, oil. I mean, again, it'd be interesting to see as and when oil does stabilize, but I'm not bright enough to work out when that might happen or why.
But yeah, the entire commodity complex has been hit really damn hard. I was interested to see a while back that diamonds, if you take sort of the average 1 carat diamond index, they has been absolutely crippled by it was going down already.
And also the diamond traders themselves can't meet to assess these things. So again, the market's gone through the floor.
Yeah, it's interesting where it's the supply shock. You would think that the supply shock would at least lead to an increase in price due to demand remaining relatively constant. But in this case, with the diamonds, due to, I think, India as the main sort of refining area for diamonds, that being locked down completely has just totally scuppered the market. Which maybe I don't think many people, or maybe people will be getting engaged after this.
I think we're going to see more divorces than engagements, sadly.
Yeah, maybe the second-hand engagement ring market maybe sadly booming. We'll just have to wait and see. In terms of what you're looking at, slightly further down the line. Interestingly, as we were talking about with commodities in general, the industrial metals like platinum group metals are in a very interesting state at the moment. They were booming until the Wu flu arrived, and now they're taking a big hit, but they're not getting absolutely demolished like copper is either. I'm assuming that this is a supply issue because so many mines in the world have been shut down. You pay attention, even though you're more a monetary metals guy, gold and silver. You do take a look at the likes of platinum, palladium, and that. Do you have any views on that?
No strong views on those. As you say, that I discriminate between the monetary metals, gold and silver, which have been money good for thousands of years, and the industrial, the more cyclical industrial metals like platinum and palladium, which, while rare and valuable, don't have the same monetary characteristics. So it's basically what we're looking to do is trying to protect client capital from basically currency debauchery, would be one way of putting it. And I think one thing that this mess is accelerating is basically a loss of confidence in the entire fiat system. Someone else who's made that suggestion even more explicitly is a gentleman. Just to see if I can find his piece. It's someone from Gold Money. McLeod is his name.
Alistair, yeah.
Alistair, yeah. And I noticed that he put an essay up recently, basically pointing out that I think it's actually an open letter to Boris Johnson, in fact, pointing out the damage that's going to be inflicted on not just the economy, but the entire monetary system by basically all these checks being written. And we're living in extraordinary times, so I'm willing to give politicians some benefit of the doubt, but in the same way that there's nobody in the cabinet who's apparently got proper science background, there's nobody in the cabinet, I suspect, that's got a proper sound monetary background either. And these are very alarming. This is one thing that has to change after this, when the dust settles, which is we need people in government, who can, who won't be fazed or bullied by some random science guy making outlandish forecasts about how many thousand people will die as a result of a pandemic that nobody knows anything about, but also these are the guys that are writing the checks, and they need to have someone sort of just reining in their more animal spirits.
Yeah, it does seem hard to imagine in this environment now. A sound money campaign, gaining ground. It does seem like
but it's never been more urgently needed. So this is the great irony of things.
Yeah, the grand irony of it all. Interestingly, you say with the incipient inflation, we've had the central banks have gone straight to the 2008 playbook and then some.
Yeah.
Interest rates to zero, asset purchases. ECB is now going to wade into the junk bond market as well, which was crazy. There were already European junk bonds that were trading negative before this happened. The fact that they are now going directly into it to print money to buy them will result in some delightfully grotesque financial instruments.
Well, baseball cards is next, apparently.
Oh, yes.
They'll be buying baseball cards.
Yeah, cigarette cards maybe over here. Maybe they'll make a comeback.
Yeah, absolutely. Old comics.
Yeah, why not? Why not? Collect. Yeah, what kind of collectibles could we sell to the Bank of England? There's all manner that we could.
Well, I'm still recovering from the shock of finding out that all my 2000 ADs of a 1976-77 pedigree got basically taken to the skip, because if we'd kept them, they'd be worth a pretty penny. Some of them were in mint condition. So you can put a price on anything these days.
Judge Dredd and everything. That's
Judge Dredd, Thog, Borag Thung, all went sadly.
Oh, you could have sold them to the Bank of England.
Well, or to the ECB, perhaps.
Well, we have seen on the central bank side, going straight to the crisis playbook. But of course, back when this, during the last crisis, there was, as I'm sure you were aware at the time, there was an open letter that was signed by all of these hedge fund managers and economists at the time, saying it was addressed to the Federal Reserve, saying we do not these continued quantitative easing programs. We don't want. We are very afraid that they're going to create a big debasement of the currency. It's going to create much higher inflation. And this was, as I say, signed by some very notable members of the financial elite, and it was seen as this is and this was post-crisis. It was a while after, and it was when gold was booming at the time. Afterwards, however, the increase in CPI, at least, consumer price inflation, did not arrive in the US, and everyone was on, well, even though QE was inflationary in theory and deflationary in practice, as I think Ben Bernanke once called it, there was everyone was wondering where had the inflation gone, and it appeared that it had gone more into asset prices than it had into the real economy.
Sure.
This time around, we have the central banks doing the same thing again. But I think the key is here is that the government, there will be direct fiscal stimulus. You have the other side.
And not only that, but sorry to interrupt, but not only that, but also you've had explicit acknowledgement by the central banks, and they're not going to give a toss about inflation trading running somewhat hot, let's say. So, I mean, they've been fiddling the figures for years anyway, so I'm not sure anyone really trusts them. I mean, that's one of the things about this crisis, that it's throwing up all kinds of issues over loss of trust in key institutions. Whether it's the World Health Organization or central banks, government, the NHS, et cetera, et cetera, et cetera. I mean, the list is practically endless. But this is the problem, that there's been a growing lack of trust in monetary affairs going back at least to 2008, and this is really going to bring things to a head. So I think people are right to be concerned about that, and right to be concerned about inflation. Let's be honest, they've been diddling the figures for years. So real inflation in the States is probably, 10%, as opposed to the sort of notional 2% target that even the Fed can't hit, and they claim to be underscoring rather than going above it. So the whole thing's nonsense. The whole thing's cobblers.
Yeah, there is the very interesting case of various inflation statistics, whether or not they're being manipulated, whether or not they'd be accurate in the first place, because you're taking people who earn different amounts of money, they spend it on different things, which change in price in different ways and the like. Interesting the comment on trust. There is the In Gold We Trust report by Incrementum. That is prepared every year, and they do loads of updates. I'm sure you're aware of it, Tim.
Yeah. Ron is a good friend. Ronnie
Yeah,
Sterfeli.
Ronnie Sterfeli is the main writer on it, but Incrementum is a very interesting sort of fund management house, and they do and to anyone listening to this, they do an annual free report called In Gold We Trust, which is just done by written by Ronnie Sterfeli, and you can get a small version, a brief version, or if you're a real nutcase like me, you can order the full. I think it was 120 pages was the last
It's
one.
pure gold bug porn.
Yeah, exactly. It is full of like crazy charts and lots of interesting insight, looking at gold in different ways. But one of the recent In Gold We Trust reports did it was simply putting gold directly in that context. So in Gold We Trust is the name of the report, but it was talking about gold in a time of declining trust in all of those institutions, like you listed, and how gold does poorly when people trust in fiat currency and the fiat governments which rule over it. And it was just saying, if you look at the rise of populism as it is described in all of these various countries out there, you can see that there is this decline. That there's a bear market in trust, effectively. That's when there should be a bull market in gold. Would you agree with that?
Oh, 100%. So I mean, I think the US dollar has lost 98% of its purchasing power since the Fed was instituted in 1913. Sterling will be comparable. I think Ronnie used this observation in a recent presentation at the World Gold Council, World Gold Forum, that gold was already the best performing asset class of the 21st century, and that was before the pandemic. So there's still time. If you don't own this stuff, you can still it's not too late.
Yeah, it's always a sort of okay. My first major investment was a gold coin, and that certainly done me well over the years. But I always think it's important that you should at least own a little gold. It doesn't you don't have to throw the sink at it, but
Sure.
always having a bit will always do you in good stead. But Tim, I think we have run out of time for the day. Do you have any closing remarks that you would like to leave with our listeners?
Let's be careful out there.
Quite. That sums up another market broadcast from us here at Southbank Investment Research. My name is Boaz Shoshan. It is now 32 minutes past 10. I hope this finds you in good spirits and in good health, and I shall be back tomorrow. Have a good one.